on to wickfills. Wickfield trades. Wickfield trades are actually the best trades to look out for, because most of the time it's most likely that price will actually fill the range of a wick, because they have to retest the low for them to actually go, or for them to then reverse or to continue going lower. So wickfields are basically, let's say price made a rejection. Let's see, around this area actually. All right, so we can say looking for the best example. Okay, the best example. All right, so you see this candle right here, this candle right here. So it has a wick at the bottom and a wick at the top, but that doesn't necessarily have to have a wick at the bottom and a wick at the top. It just needs to have all right.
What?
Okay, so a wick view, right? You know how a good candle has a wick at the top and a wick at the bottom. That's called a good candle, because when a candle has a wick at the top and a wick at the bottom, it means that it has area to range on. Those are good candles. But if you have candles, a candle like this one.
I need to a little wig. Now. Now.
You're looking for something. Okay.
Akko, mute yourself. All right. Wickfields. A good candle has a wick at the bottom and a wick at the top. It doesn't have to be big. It doesn't have to be too small. It just needs to have a wick at the top or at the bottom. The reason why, it's because it gives the next candle an area to range. If a candle closes with no wick at the top or no wick at the bottom, similar to this candle right here, it's not really telling you if price could go higher or if it go lower. Of course, it's saying that there is like strong bearish pressure that's happening right now. Of course, there was strong bearish pressure considering where market structure was and where it was going. However, let's say markets are ranging and you get a candle with no wick at the top or at the bottom, similar to, let's say, similar to this one or this one, right? Those candles don't have wicks at the top or at the bottom. Yeah, this one or even this one. So the reason why, or even this one too, even this one. All right, so these are good candles because price was actually trending. So price had broken out and it was actually trending. Similar to this one, price broke out here, right, and it was trending bearish, and then we got this candle that's showing us that there's a lot of selling pressure. But if you see a candlestick without any wick at the top or at the bottom, at an area where market is ranging, let's say at a high or a low, say we have resistance right here and we had support right here. We can even say we had support right here. All right. Wow, that's actually perfect. Let's say we have our resistance right here and we have our support right here. Right? You have this wick, this candlestick without any without any wicks, we have that candlestick, and we have this candlestick. So the reason why we don't trade candlesticks that don't have wicks, it's because you never know where it's going to go. It doesn't have a wick at the bottom for price to range it. It doesn't have a wick at the top for price to range it. It's not showing you any rejections. It's not telling you anything. That means there's just people in there, and let's say maybe the buyers overtook the sellers. And it also depends with the time that candlestick is happening. So most candlesticks without any wicks at the top, you will see them happening maybe during Asian session or late New York session, but sometimes they do happen when market is actually printing properly and there is actually volume in the markets. And when you see a candlestick like that, right, we always say wait for the next candlestick, because the next candlestick is the one that's going to tell you where market is actually going. For example, at this area right here, for example, this area right here, you see this candlestick, right? It didn't have it has a small wick at the top, but that's not a big wick for us to say market can actually range. So market made a high, right? And then it established this high. Remember, we said when markets prints bullish candles and then we see a bearish candle happening, it's establishing resistance and it's trying to create new support. So we could say market established a resistance right here. We can actually say that because it did establish a resistance right there. And then you had 4 candles that were right next to each other, right? So if you were looking for a trade, right, considering that market was printing bullish candles, you would have to wait. You can't just sell, because on this bullish trend, right, market made a resistance right here, and then it created support right here. So when it created support right here, it then created a new high, which created a new resistance. And for you to actually sell, we know that market has to break the support for us to sell. So this would have been your selling candlestick if you were in the markets and you were looking for a trade. That would have been your confirmation, right? So you are watching price from this area. So you see these two bearish candlesticks, right? That's price telling you that price could be bearish. It is pushing in that direction. And then you got this candlestick without any wicks at the top or at the bottom. So someone would actually buy on this candle because it's actually a strong bullish candlestick. That means it might be an engulfing candle. Someone might look at it as an engulfing candle. But it didn't break the resistance that was created. Of course, it's an engulfing candle that could actually push price higher, since we had market move up and then we created support and then it pushed higher. So this could have been just a correction for market to push higher, but this candlestick doesn't have any wicks for price to range it. That's why we say wait. So if you had took a buy on this candlestick, right, you would actually be in a very big loss, because there isn't any range for market to actually show you any direction, any proper direction. It's a stale candlestick. It's not telling you anything. It's just pushing a long time. Look at it that way. The next candle that happened is the one that's actually telling us what to do, right? That's where we have this bearish candle. So this one would have been your signal for sales. This bullish candle might have been an engulfing candle, but this, I would actually look at this candlestick as an engulfing candle. So an engulfing candle can just cover up one candle, right? It can do that, similar to this one. This could be an engulfing candle also. However, I would prefer a strong engulfing candle to cover at least minimum 2 candlesticks. It needs to cover minimum 2 candlesticks previous to that price action, and this one is actually covering 3 candlesticks, 4, 5 candlesticks, because if you look at it from here, 1, 2, 3, 4, 5 candlesticks. I would call that a strong engulfing candle, because it's covering all of this action that was happening right now. And how many hours? 5 hours of that action, and one candle just covers everything that happened within 5 hours, that's a strong candlestick for me. So that would have been your signal to sell. So if you would have sold here, right, you would have sold right here, let's say when this candlestick opens, right, or when this candlestick closes, right, and you would have had your stop loss. All right, and you would have had your stop loss, let's say above your engulfing candle right here. And then the range that we talked about, you always need a range. You don't necessarily need the range, but if you see a signal or a candlestick or a pattern that's telling you something, and then after that you get a range, it doesn't have to be a big range, even just a small range, that's your confirmation. So if you had entered when this candlestick closes, right, and then you get this candlestick, and then you start seeing this candlestick happening next to each other, right, that's your confirmation that price is high chances of actually falling, and it actually did fall. So what would have made you more confident about the trade is when you get a range, right, they always give you the resistance, the high of that range, that's the high of our candlestick right here, and the low of that range, right? And you didn't get any candlesticks that were closing above the high of our of the range, or the candle that's giving us the range. That means your trade is still valid. But if a candlestick came and closed above the range, right, then that's price invalidating your setup. So the only thing you have to worry about is price closing above your range. Candlesticks closing below your range, that's good for you, because if price is creating a low, right, and it gives you a range on that candlestick, right, and then you have, let's say this candlestick closes or even leaves the wick lower, that's price breaking the low. So the wick that would have dipped lower, right, it's breaking the low, testing, let's say testing these new waters, right, for price to continue going lower. Price leaving a wick at the top, it's also good, because when price leaves a wick at the top, right, it's accumulating more buyers for price to sell. So when price dips into the top, probably they are stopping people out who have their stop losses there, and they are fooling more people to think that they are buying only for price to go lower. So wicks at the top is also fine. It's only that price cannot close above there. It needs to close back in the range. So no matter how it closes back in the range, as long as it closes back in the range, that's fine. Because if we were looking at these candlesticks, right, we can see this one didn't have much buying pressure, right? That's a good sign. And then you had a strong bearish candlestick. Well, it's strong, because if you look at the previous candlestick, it didn't have anything. This one actually has some sort of a board, so we can actually say it's strong selling candle, right? And then you have this bullish candle, right? It is strong in a way, but it didn't close above our resistance. So no matter how it closes in the range, as long as it doesn't close above our resistance, price is still pushing in the direction that we need it to push into. And then you have another bearish candle, and then you can even see by this candle how when it first started printing, it was bullish. That's how you have this week, right? It was bullish, and then it pushed lower. So that push higher didn't close above. The moment price does not close above your resistance, it's just pushing price lower. No matter how many candles it prints in the range, as long as it does not close above, it's just pushing price lower. So that's what you need. But if let's say if we were looking at bullish price movement, right, then we would then need price to push higher. But right now it did not push higher, it only pushed lower, which is good for us. And then from here, we price pushed lower, right? So that's on candlesticks without any wicks. You can even check this bullish candle, right? The last bullish candle, it didn't have a wick at the bottom. It had a very small wick at the top. It's not giving us any room for price to play around. you need a candlestick with a long wick for price to actually give you something, or for price to range it, and for price to push you into the next direction. It's the same as if we look at, for a wick fill, I would suggest looking at let's say let's look at gold. Need a candlestick with a proper wick. All right, this is a good example. All right, so wick fills. In the morning, we actually did trade a wick fill. The gold trade that we did in the morning, this trade, that was a wick fill trade. However, see, this candle that just printed right now, it's a very good candle. Despite the candle being big itself, you can look at it as something similar to this or even this, but it's a good candlestick because it has a range at the bottom, it has a range at the top. So a wick fill, right, you would need price to close with a very long wick like this. This is a good wick. I would say maybe even 10 pips, depending on the pair that you're trading. 10 pips minimum is good enough, because we always strive for 10 pips. 10 pips going higher, it's fine with us. So 10 pips minimum going higher for your wick fill if you want to trade a wick fill trade. So when price comes back and closes all the way down here, right, price is telling us that it had the power, it had the pressure to push all the way high to this area, right? So when price pushed all the way and created a resistance right here, of course price dropped and created another resistance right here, right? But this wick actually left a resistance at that high. So we can see, we can get price maybe coming down. It will get some bearish pressure or one or two bearish candles, right? Create support, right? And then if you see price coming back all the way and you get candles closing around this area, right, then high chances the next candles that are going to follow, right, they are going to close above the resistance and they're going to push higher. So when they push higher, right, you'll be aiming to target this wick. That's a wick fill, right? So when price comes back into this wick, right, it might even just touch your price and even pull back. That's the thing, because if price touched a certain area and rejected, it's most likely going to go back into that area to retest before it can properly reject. So if this is going to be a proper rejection, we should see price come back. We should see price maybe create some few candlesticks, bearish candlesticks, and then continue with the wick fill. If it doesn't, like right now, let's say right now price doesn't actually come back or doesn't create any bearish candlesticks, right? Since price is still right here, if these candlesticks, let's say on the 30-minute or even on the 50-minute time frame, right, if it closes bullish like that, it's most likely price will actually keep going up to cover this wick, and then from there we might start getting some rejection, or it might even continue going higher. That's a wick fill. Another example that we can look at is if you look at this candle, this candlestick right here. So it's the same scenario that I was trying to explain, where price will create some bearish candlesticks before it actually fills the wick. So let's say you're watching price and it made this wick right here, right? And then you have candlesticks that are printing next to each other. They are not creating a new high or a new low. They're just printing next to each other, because when price created this wick, it created a high right here, right? And then after this high, price came all the way down, it closed here, and the next candlestick created a low right here, right? This candlestick created a low right here, and it established a resistance also right here. Yeah, that resistance. Remember, when a candlestick closes, all right, remember when a candlestick closes and opens, like we talked about earlier, that candlestick is creating a high and a low, and in that high and a low, price might range between those 2 points, or it might create a new high and a new low for price to show us where it's going next. But right now it created this low, and then it created this high. So that's our high and our low. And our strategy, if we were looking for a trade, we would be expecting price to break this low, and then we can continue on to the next low, or if price breaks this high, and then we can continue on to the next resistance. So right now, let's say we are trading, right, and we don't have all of this information, and we have this range. Now price is ranging in between this area. Remember, we said as long as price doesn't break the high or the low, it will continue ranging. It's not showing us any direction, right? So price kept on ranging inside this area, right? And then all of a sudden you have a very strong bullish candle that's printing right here, and then the next candlestick is the one that met the wick fill. So this wick going all the way high to touch this high is price retesting for it to go lower. Remember, price always retests. If we have a breakout, price will retest. If we have a rejection, price will go and retest that rejection to confirm. So the first rejection or the first breakout is your signal. The retest is your confirmation. So price did breakout because even before any of this happened, right, even before the wick that we're talking about happened, and if we were just looking at the candlesticks, right, and we're looking for a trade, we would have had our support right here, our resistance right here, right, and then would have had our support, let's say right here, right? So if we have our support right here and we have our resistance right here, looking at our strategy, what do we expect? We expect price to break resistance, and then we enter covering this clean traffic to our left right here. And then if we wanted to enter sales, we wanted price to break this support, cover this wick right here. So wick is just similar to clean traffic. Clean traffic is only showing more properly because of the candlestick, but the wick is also good clean traffic. So we would have been expecting those two trades, right? So when this happened, price then came and then it broke out, right? And it went on to test this high. Remember when we talked about order blocks, if price wanted to get into this range, it would have, but it didn't. It tested this high. So that should tell you that there is an order block around this area. To confirm that order block, and not to confuse you, just to confirm the order blocks, because we have talked about them before. So I'm just going to show you to confirm that there is an order block there, or there was an order block there, right? You have 1 this week, touched, dropped. You have 2 this week, it touched and it dropped. You have 3 this week, it touched this area. See, it even passed. It then passed because they might have already filled all of their trades here, but it did get into this area and it still came back to close right at our order block. If you let's say we move this line all the way down here, see, it's still right on our order block area. That's showing us that there is an order block right there, and for that order block to fulfill, we need price to start ranging in this area. So when price starts ranging in this area, right, then it's invalidating this order block. But if this price doesn't manage to come and close in this area, and then it drops and it gets back into this range, like earlier when I just said, when price drops back into this range, then this is no longer an order block. This is more of a consolidation, because if you look at it on the 4-hour time frame, there is a consolidation that's happening. So if price does range in this area, then it's invalidating the order block. But if it doesn't and it drops back into this area, then expect price to drop even further. All right, so from here, when we're looking for our wick fill now, if you look at them at this week, right? So we were watching price on this high and we're watching price on this low. Then we had this candlestick that happened, right? It dipped up and then it came back to close in our range. So remember when we said price goes high, it will come back to create a new low and then to go higher, right? If the price doesn't come back to the low, then it's just creating a low high. That means price can actually go up. But if price comes back to the low, then we could expect it to drop. All right. However, if you look at this price, it was ranging properly. As you can see, it was at our high, it's coming back to our low, as you can see around this area, and then all of a sudden price is now playing at our high. So this candlestick dipped out, and then you have price ranging at the top of our range. If you see a range, if you see a big range, and then you see price ranging at the top of that range, trust me, expect for a bullish breakout. If you see a big range, let's say a 4-hour time frame range, right, but then you go on the 1-hour time frame and you see price playing at the bottom of the range, price is most likely going to break it's most likely going to cause a bearish breakout. Because if price, let's say for example right here, right, if price wanted to break out at the bottom right here, right, it would have at this area. So before even that top range happened, right, if price was going to break out at this area, at the bottom, right, it would have broken out right here. The reason why I'm saying that is we were even watching this trade yesterday. I remember that's the one that we were watching yesterday. See, price made a high, right? This high was established right here, and then price came down to this low, right? Inside this range, instead of price actually coming down and then going back to our resistance, it didn't. It actually closed let's say in the middle of our range, and started creating resistance right here, right? So when we say resistance was created, see, we have bearish candles, right? They created support, and then we have this bullish candle that's creating resistance. We had another bearish candle that's establishing our support, but we had a bullish candle that's confirming the resistance, right? So if price was going to break out, right, it should have broken out between these two candlesticks. So if you were looking for a trade, right, this bearish candle would have been your signal to sell. And if you had sold on this candlestick, right, you would want your next candlestick to be bearish. If it closes bearish and below your support, that's your confirmation that price will continue in that direction. But if your candlestick doesn't close bearish, and then it closes bullish and right back in the range, that's invalidating your setup. But however, it's only invalidating your setup if it actually breaks the resistance of that range. The reason why I'm saying that is you can look at price structure right here. See, you have this bearish candlesticks, right, and then you have this bullish candlestick that created resistance, right? That was when resistance was being created, and then this candlestick established resistance, right? And when the new candle opened right here, this new candlestick, right, it was bearish. That's why we have this long wick. It was bearish, and if it had closed bearish at the bottom, see, even reached the bottom, then price would have dropped. So the moment this candlestick closed above this small range inside our big range, it was pushing price higher, back to our normal resistance. So when price closed back to our normal resistance and it even went to breakout, that was invalidating all sell setups. So now we're only looking for buy setups, right? So buy setups were confirmed by this range. The same thing that happened at the bottom, this range was confirming sell setups, but then this candlestick broke out and closed above. So this range, the more it refuses or it rejects closing back into the bearish range, it's confirming more and more bullish buyers. That's when you end up trading a wick fill like this one. See how this wick it filled this wick. So this was our signal, right? And this candlestick will have been a confirmation, because remember we said if it's trading at the top of your range, it's most likely going to break out. And when you look at our previous two candlesticks, right, they are bearish candlestick, and we have one bullish candlestick that's covering, it's actually covering 1, 2, 3, 4, 5, 6, 7 candlesticks. Remember we said for an engulfing candle to be strong, you want it to cover at least a minimum of 2 candlesticks. It does not matter how big that candlestick is. I know some people who want an engulfing candle that's similar to this one. I mean, this is a good candle, like this big one. It's a good candle, but it's not going to happen always. Some people will expect maybe an engulfing candle like this one, but that doesn't matter. It just needs to cover at least a minimum of 2 candlesticks, and it was covering, and it has a range. It has a wick at the bottom. It was a range. The only wick that you had to worry about was the top wick. It didn't have the top wick, but this is gold. Gold will push price higher in a second. So you would have, the moment this candle closes, you would have entered your bias, because this is even closing on the 1 hour time frame. It's even confirming your analysis on a bigger time frame, which is good. So you would have bought when this candlestick closes, and your TP just a few pips into this wick, and your stop loss right below the wick of your previous 1 hour candlesticks. So with other pairs, we can actually look to put our stop loss. We can look on the 50-minute time frame so that we can put our stop loss somewhere inside the range of this candlestick. But this is gold. The thing with gold is it can wick down first before it pushes higher. So it would have been better to put your stop loss right below the candlesticks, a few pips below, and then for it to push higher. That's a wick fill. So you'll be trading the wick fill. You're not expecting price to continue going higher. You're just expecting price to trade in the range of the wick and do whatever it does next. But what you want is, you just want to trade the wick fill, and that's it. Because the wick fill is 90% chance it's going to fill before it does anything else. It's very similar to this setup that happened earlier today. If you look at this, so let's say we have our support right here, right? And we did trade this wick fill, but this is much more clear. So you see how price was slowly pushing lower, and then all of a sudden you have a strong bearish candle. So this strong bearish candle, right, was telling you, or was giving you signals that price is high chances of dropping. So when I say signals, right, it's telling you where the selling pressure is. That's one. Two, your confirmation was it broke the support, right? That's A. And two, there's a wick fill, right? You see there's a wick right here. There are no candlesticks that traded in this week. That's one thing you have to understand when you're trading a wick fill. There have to be no candlesticks that have traded in the range of that week. So when I say the range of that week, we're looking at the area where the week starts, and let's say the area where the week ends, right here. Right? So that's your range of your wick fill. So you had support already around this area, which is good, and then you get price showing you very strong bearish pressure towards your support. Remember, if we're expecting the trend to reverse, we need less and less pressure as it approaches the support or the resistance. If price approaches your support or your resistance with very strong pressure, then it's most likely going to break. For it to reject, it needs to approach that area with very little pressure, but it approached our support with very strong pressure. If it had approached our support, let's say, if it had approached our support with candlesticks like these ones, then we wouldn't expect price to make a wick fill. But it approached our support with a very strong candle, which is pushing price lower. So all you have to do was to sell the moment this candle closes, right? Even if you don't sell the moment the candle closes, right, and you want a more safer entry, you can sell 50% retracement of your previous candle to push price lower, aiming for the wick only. So you'd have maybe TP somewhere here or a little bit higher, since this is gold, but you're just aiming for that wick fill. You're not expecting price to go all the way lower. You just want the wick fill. That's a wick fill. But to make your wick fill more profitable or more stable, to make it an easy trade, always make sure that there are no candlesticks that have traded in the range of that week. It has to be a clean range. That means clean traffic. The same thing with candlesticks, clean traffic, because we know price always fulfills clean traffic. There isn't anything to disturb it from moving to that area. I don't know if you guys have any questions, but going back to order blocks, Remember when we said there's an order block around this area? There you go. This is the order block. See, price is dropping. That means the order block around this area is filling. So we can say this could have possibly been accumulation of orders, because people were probably expecting it to go higher. The moment it closes with a very strong bullish candle like this one, people expecting to go higher. But there is an order block that we mentioned earlier right here. So price is dropping. If this candle closes inside this range, we can expect price to drop tomorrow or even next week. If it doesn't drop tomorrow, as long as it stays in this range, it will drop. But for price to actually go higher, we only now need it to close above this area. So if you see price dropping and then it comes back and it starts playing around this area, look out for a trade to fill this week. This is a big range. It's a very nice range to trade. Look out for a trade to trade this week. So price can do whatever it does. If it keeps rejecting this low and then it comes back and starts trading, let's say around this range, we can actually catch a trade after that week. This week only. Don't expect it to go any further. It might go that further, but we're only looking for it to fill this range. So now it's all about waiting. I'm pretty sure I muted you guys, but do you guys have any questions? I'm gonna guess no. So remember earlier we said we have a trade on GBP JPY. That's good. So remember earlier on we said we have a trade on GBP JPY. Well, we're expecting price to break this high. It did. Of course, our previous candle didn't exactly close the way we wanted. We wanted this previous candle to actually close above, but since it didn't, that's fine. And we have this candle that's printing right now that's closing above, or if it does close above. So let's look at the 30-minute time frame and see how it closed. The 30-minute candle closed above, which is good. So if the 1 hour candlestick closes above this area, let's say even the way it is right now, we can actually expect price to hit the area that we were expecting it to get to, which is this area. But don't forget about this